You ever hear the saying, slow and steady wins the race? Well, today's story proves that and then some. Because while everyone's chasing the next Tesla or trying to day trade their way to glory, there's one boring stock that quietly turned $10,000 into over $10 million completely tax-free in just 25 years. Yeah, you heard that right? 10 grand to 10 million. No crypto. No AI hype, no meme magic. Just pure, boring, compounding power. And the craziest part? It's still going strong. Let's start with a guy you might have heard of, Warren Buffett. Buffett's whole philosophy is simple. Buy good businesses, reinvest dividends, and then do absolutely nothing. In his 2014 letter to Berkshire Hathaway shareholders, he broke it down beautifully. He said, if you invested $1,000 in the S&P 500 back in 1964 and just sat on it for 50 years, you'd end up with about $24,000. Not bad. But if you had reinvested your dividends instead of spending them, that same $1,000 would have turned into $112,000. That's not a typo. That's just math, the kind that quietly makes you rich while you're busy living your life. See, everyone gets excited about stock prices, the daily ups and downs, the flashy tickers, the endless noise on CNBC. But the truth is, dividends, those boring, predictable cash payments, are what actually drive most of the market's long-term returns. According to Hartford Funds, since 1960, reinvested dividends account for a whopping 85% of the market's total returns. Let that sink in. Stock prices only give you about 15% of the wealth. The other 85% comes from quietly putting those dividends back to work. Buffett figured this out decades ago. In the late 1982, he dropped $1.3 billion into Coca-Cola stock. Today, that investment sends him around $816 million a year just in dividends. And Coke has raised that dividend every single year since he bought it. That's an 8% annual increase for 37 straight years. It's like buying one house and having your tenants pay you back almost the entire purchase price every single year, forever, with the rent going up 8% annually. Try finding a rental property like that. Now, Buffett loves consistency companies that raise dividends 5% to 8% per year. Safe, predictable, steady. But what if you found a company that didn't just grow dividends by 5% or 8%, but by more than 20% every year for 25 consecutive years? That sounds impossible, right? Or at least suspicious. Like, how do you even keep that up? Sell organs? Print money? Nope, just pure operational discipline. That company exists, and its name is Canadian Natural Resources, ticker symbol CNQ. You've probably never heard of it, because it's not sexy. It doesn't build rockets or chatbots. It pulls oil out of the ground in Alberta, Canada. And while Wall Street analysts are tripping over themselves to talk about tech stocks, they basically pretend CNQ doesn't exist. Because, let's face it, in today's world, recommending an oil company is about as trendy as bringing a fur coat to a vegan potluck. But while the world's been distracted by hype cycles and hashtags, CNQ has quietly delivered one of the most astonishing financial miracles in modern investing. So, Wall Street loves its royalty titles. You've got your Dividend Aristocrats companies that raise their dividends for 25 straight years. Then there are the Dividend Kings, who've done it for 50. They're the old money of the investing world. Respectable, reliable, and honestly, kind of boring. But even the kings stumble sometimes. Think about the last 25 years. We've had the dot-com crash, the 2008 financial meltdown, an oil crisis, and a global pandemic. Even the best companies hit pause on their dividends during those storms, except one. When oil crashed to negative $37 a barrel in 2020, yes, negative most oil producers panicked. They were literally paying buyers to take oil off their hands. But CNQ, they didn't flinch. They calmly increased their dividend again. That's right. Even when oil prices collapsed, CNQ's management stood firm and said, yeah, we're still giving our shareholders a raise. and they've done it 25 years in a row, averaging 21% annual dividend growth. Out of 53,000 publicly traded companies on Earth, only CNQ has done that. If that's not a financial miracle, I don't know what is. So how does CNQ do it? How does an oil company pull off this level of consistency in one of the most volatile industries on the planet? It comes down to one word: discipline. These guys run their business like monks guarding a treasure. Every decision revolves around free cash flow, the real money left over after all expenses and investment. In 2024, even with wild swings in oil prices, CNQ generated $5.9 billion in free cash flow. Their break-even price for oil is around $40 to $45 per barrel. That means they're making money even when the market's having a nervous breakdown. And their operating costs? Roughly $15 per barrel. That's lower than what a lot of people earn per hour. But here's the real secret sauce. Most oil companies have production that declines by 30% to 50% every year. They have to constantly drill new wells just to stay even. CNQ's oil sands operations, though, have a 0% decline rate. Once they build a mine, it keeps producing for decades. It's not like drilling, it's more like running a factory. Predictable, stable, and scalable. Combine that with a smart capital allocation system where shareholder returns automatically rise as debt falls, and you've got a machine engineered for long-term dividend growth. All right, let's put this into perspective. Say you invested $10,000 into CNQ back on January 2nd, 2000. You're 45 years old, just starting to think about retirement. You buy 12,500 shares at $1.20 each. Then you do the hardest and smartest thing an investor can do: nothing. You reinvest every single dividend. Forget about the stock price and just live your life. Over the years, CNQ goes through 4 stock splits, multiplying your shares, and those dividends keep growing year after year after year. Fast forward to 2025. You're 70 years old, ready to retire. You open your account, and holy compounding, Batman, you now own 322,772 shares worth over $10.3 million. And remember, this is inside a Roth IRA, so it's completely tax-free. That's not a typo. That's what 25 years of 21% annual dividend growth looks like. Your annual dividend income alone? $762,550. That's 76 times your original investment every single year, paid passively. And if that 21% growth continues, you'd collect over $7.7 a million in dividend income between 2026 and 2030 without even touching your $10 million nest egg. Let that sink in. Your money is working harder than you ever could, and it's not paying a dime in taxes. Now, there's one small caveat for American investors. Canadian companies withhold 15% in taxes on dividends for non-residents. But here's the loophole. If you hold CNQ inside a retirement account, like an IRA or 401, that tax is waived. In a Roth IRA, it's even better. No withholding tax, no capital gains tax, just pure compounding bliss. So, if you structure it right, CNQ doesn't just make you rich, it makes you rich tax-free. So why isn't everyone screaming about CNQ from the rooftops? Because it's not trendy. It doesn't have a charismatic CEO tweeting memes. It doesn't claim to be saving the planet or disrupting anything. It just quietly makes shareholders filthy rich. And that's not exactly headline material in today's world. Analysts chase buzzwords AI, EV, cloud, quantum. Meanwhile, CNQ just keeps doing what it's always done, generating massive cash flow, paying down debt, and rewarding shareholders. In an age of hype, CNQ is discipline incarnate. So, what's the lesson here? It's not about picking the next big thing. It's about owning something great and giving it time to work. Compounding doesn't care about fads or headlines. It rewards patience and punishes distraction. Most investors fail not because they pick bad stocks, but because they don't stay with good ones. If you'd held CNQ through oil crashes, pandemics, and every doom headline of the last quarter century, you'd be a multimillionaire with a 7-figure annual income tax-free. That's the power of reinvested dividends. That's the power of patience. And that's why the boring stuff often wins the race. So the next time you're tempted to chase the next shiny thing, remember this. Somewhere in Canada, there's a company that quietly turned $10,000 into $10 million, while the rest of the market was busy panicking. Sometimes, being boring isn't just safe, it's genius.